I'm going to go through the biggest risks in global equity portfolios today. Buckle in, it's going to be, I've got to cover a lot in 15 minutes, so I may not take a breath until I get to the end. So here are just a few of the risks that we see. I'll let you read them, I'm not going to go through them. I'm sure we could actually find many more than the ones above. Some, like these highlighted in green, are already with us, understood and providing reasonably obvious investment opportunities. And some, such as these that I've highlighted in red, are just possible threats, and we'd argue some, like the risk of rising interest rates, are actually unlikely to eventuate in the next 10 years. But one, identified by the Hyperion investment team, is sitting there in plain sight and not well understood. So lower global GDP growth has actually been identified in a recent Hyperion white paper by Mark Arnold and Jason Orthman, who are on our team, CIO and Deputy CIO, as a substantial risk to global investors. Global investors are overexposed to thousands of poor quality companies from which they will make poor future returns while waiting for a mean reversion. So the majority of companies actually rely on high economic growth to prosper. Their sales growth, their earnings growth, and their share price actually depends upon it. But the effect of a slow deterioration in GDP growth on share prices has been masked by falling interest rates, which have re-rated all businesses as earnings have stagnated. The factors that drove economic growth post-World War II, such as population growth, the unfettered use of fossil fuels, low levels of business disruption, rising workforce participation rates of women, that these things have either reversed or peaked. Interest rates bottomed out post the GFC, so there's actually limited further interest rate driven re-rating possible, and as a result you have 10 years post the GFC where average businesses have struggled. So the bad news is there's no joy in sight for those businesses. GDP growth will stay low, as will interest rates, as will inflation. Modern information-driven businesses not reliant on GDP growth are either expanding their addressable markets or even taking market share, or sometimes they're doing both. That is, delivering overall addressable market growth and actually market share growth. So a larger slice, if you like, of a bigger pie. And they're driving substantial earnings growth in the absence of economic growth. So this is a chart of US stock market returns by each decade over the last 120 years, split into returns from dividends in blue, price-earnings ratio changes in red, and earnings growth in green. And in recent years, the reduction in dividend component is evident looking at those last couple of boxes. The 80s and the 90s, circled here in red, were the years of the falling interest rates, when economic growth, while declining, still drove sales growth for average businesses. The share prices of average businesses actually benefited from those re-ratings. The period post-GFC, which I've circled there in green, which saw the rise of modern businesses, has been an earnings story, but the earnings have accrued to a small subset of global innovators and disruptors. So power law distributions exist in this internet-enabled world. Another way of expressing power law is the Pareto Principle or the 80-20 rule. A small number of companies make most of the money. This chart shows the return on equity for the stocks in the MSCI world since the 1980s divided by decile. So prior to the internet, disruption levels were low and the relative profitability of most businesses was stable. The relationship changed in the 1990s with the advent of the internet. In an internet-enabled world where global internet platforms have strong value propositions, power law distributions have moved from being regionally based to globally based. As a result, it's become a globalized winner-takes-all, or at least winner-takes-most market, and this has increased market share shifts. The strongest platforms with global scale win most customers and disrupt the old world regional competitors. The strong get stronger in an internet-enabled globalized world, and the strong take market share from the weak. This means lower margins and lower sales for most businesses, which are actually represented here by all those lower deciles on this chart, and of course particularly the lower decile, the bottom decile. These structural winners like Alphabet, Amazon and Facebook weren't obvious at the time we purchased them back in 2014, but of course now they're obvious in hindsight and managers are buying them. These stocks were well covered and anyone could have purchased these businesses, but incumbent managers have only begun to drift towards these names in the last couple of years. And why is that? Well, we think it's this focus on short-term metrics. price earnings, price book, enterprise value to sales, which are at best shortcuts with limited value. If you've looked at the PE ratio to provide an insight on purchase, you are actually wasting your time, as the varied positive to negative changes in ratings over time, and I've highlighted here in red. The PE of Amazon at 117 times, you can see on that chart, or MasterCard at 27 times back in 2014, told you actually little about how much you could make from these businesses in the long term. But a good look at their customer value propositions, and particularly their potential market share changes, were much more instructive. Here's a domestic example that you'd all know. REA has been a 100-bagger for Hyperion. It's always looked expensive on short-term metrics. Many years back, I was at a kid's soccer match, and another fund manager told me that at $20 a share, REA was his most obvious short. The comment was, "It's just a website, it's not a business." Well, how's that turned out? The business has had a strong and sustainable value proposition that's allowed it to take significant market share in a large addressable market. The relationship between sales per share, earnings per share, and share price has actually been tight over the long term. This chart illustrates that in the long run, it's the sustainable growth in the business earnings per share and sales per share that actually determine the share price performance. Now you might say, well, this is obvious. Just follow the increase in sales per share and the earnings per share and the price will follow. But what if you were building market share and the earnings that actually lag that growth? Well, this is the same chart for Amazon. So double-digit sales growth from market share gains in retail, plus innovation leading to the creation of AWS, Amazon Web Services, and the cloud have driven the superior share price returns. But you have to look at the free cash flow rather than the earnings to understand how it's been able to fund its growth through producing growing, positive free cash flows over the past 23 years. Again, if your main criteria for investing was a low price earnings ratio, you would have actually missed 37% compound share price growth over the past 23 years versus 5% for the MSCI World, that's per annum. And if you'd just been following the earnings, you'd have also missed the boat, as you can see in this chart. So using Amazon, let's look at some detail around market share. So the orange line on this graph is the best estimate of historical market shares for Amazon in e-commerce retail in the US. That's our estimates. The orange line has risen strongly in the last 5 years. Right now, there's roughly $5 trillion US dollars in retail sales in the US. The online component is only 600 billion. So that's an e-commerce penetration of around 11%. But in China, as Jacob's just noted, the penetration of e-commerce in retail is 25%. So you can draw your own conclusions about how far Amazon market share could rise from here. In any case, the number is substantial. The data you see here is at December 2019, but with COVID and everybody moving online, we actually expect the yearly penetration to be much higher when reported early next year. The blue line is the historical AWS share of the cloud market, with Microsoft, Google, and Alibaba the other major players. Well, AWS are starting to lose a bit of share as the other cloud companies take some share, but cloud computing comprising infrastructure and platform as a service is growing very strongly, most recently at a 5-year compound average growth rate of 45%. So it doesn't take long for the market to become a $1 trillion market, given that the existing players' total revenue is around 86 billion. So you can see the potential for all the major players in this market. You don't need to steal market share when the total addressable market is so large and the 4 winners will take most. This is a chart of Tesla vehicle deliveries moved to Tesla, another portfolio holding. The estimates actually here are Tesla's, and they're currently producing a run rate of 500,000 vehicles a year, rising to about 3 million a year in no time at all. So the vehicle sales growth story is actually a good story in itself. It's actually even better when you look at what's happened to the rest of the car market. So to June this year, there's been 28 consecutive months of deterioration in global new car sales, while Tesla has substantially increased deliveries and sales. But we've never been interested in just another car company. When they get to a production of, say, 3 million cars a year, and that's not that far out, this results in the addition of tens of thousands of megawatts of battery storage per year sitting in cars in consumer garages. Now, to put this in perspective, Araring Power Station on Lake Macquarie, just north of where we are here, is rated at 2,900 megawatts and is the largest in Australia. So we're talking about Tesla adding multiple Araring stations per year in storage to garages. So with Tesla Auto Bidder software, the storage will be available eventually to the grid as a virtual power plant and can offer services to the energy market such as frequency regulation, grid support, reserve capacity and time shifting, just to name 4 of over 18 services that you can use with battery storage. So, and if you don't know what frequency regulation is for Tesla, then Tesla's just a speculative card bet, and I understand that. But if you put it to most people, I suspect that they don't really understand the revenue that Tesla could earn from all of these services. So the substantial opportunity for Tesla is to actually dominate that virtual power plant and energy storage market through a first mover advantage. And that's just missing from most sell-side analysis at the moment. So Tesla, as I said, is a major holding in the global fund, and the pie for Tesla is enormous. There are multiple slices for them to compete for. There's the global energy market at $11.1 trillion that's yet to be disrupted at all. And then there's the global ride-sharing addressable market at $5.7 trillion, plus the traditional auto market at $3.1 trillion. So Tesla has lead offerings in 2 of these and has signalled its intention to enter the ride-sharing market once it perfects autonomous vehicles. But it's only the opportunity in the traditional auto market that the stock market is currently considering, not the whole pie. So finally, Square is taking the card terminal and the person-to-person cash transaction market by storm. They produce those small white POS card terminals, and they have a P2P cash app somewhat similar to Apple Pay and PayPal's Venmo, which is not available here in Australia yet. The total addressable market's $140 billion, and they currently have less than 3% penetration. This chart of its revenue growth versus traditional payments companies, Visa and MasterCard, shown here in grey and blue, show how Square can convert a compelling offering to small bricks and mortar retail outlets and consumers into a much larger share of this $140 billion market. It's branched into other offerings to shops, including payroll, staff management, online retail engines, and offerings to consumers, such as the opportunity to buy stocks and even Bitcoin, trade Bitcoin through the app. It's no wonder the stock's been on a tear since March, as consumers stopped using cash and started tapping cards and phones to pay for goods and services. And we don't see that trend reversing. These 3 companies, Tesla, Square and Amazon, make up about 30% of the Hyperion global portfolio. And last year, the big holdings were in Facebook and Alphabet, so it's not unusual for us to have concentration like that. We've built our 20-year plus track record as the #1 manager in equities on concentration just like this. Because we know that equity returns are always driven by just a narrow number of market leaders. Research that I put here, released in 2018, shows that the best performing 4% of US listed companies explain the entire net gain for the US stock market since 1926, as other stocks collectively match the return from Treasury bills. So this chart highlights that all the companies right of that dotted line added virtually no value. Power law relationships are also evident in fund manager portfolios. Well, at least they should be. The best stock picks usually provide outsized stock returns, and therefore, to maximise the overall portfolio return, you should supersize the holding in those high conviction stocks. So, a word of caution about applying these rules widely. Not all growth stocks are like these, and I'd probably go further to say that most aren't. There are just a few where we can draw a line from the market share gains to future earnings with a clear execution path that we can monitor with good confidence. What we are very confident about is that global growth has slowed and it's not going to change in a hurry. And while there might be some short-term junk or value rallies, they're unlikely to be persistent. The modern innovative businesses taking share are long-term winners, and many market participants avoid them because of short-term metrics. And if you're going to pick winners, you should concentrate in them. It's worked for 100 years, and to take advantage of short-term corrections like the one we're just seeing now to improve your entry point to the Hyperion Global Growth Companies Fund. If you want to read a bit more on this, there are a bunch of white papers on our website. I refer you to them. Good morning.
Tim, thank you so much for another excellent presentation.
Hi there, and welcome back, and thank you to Ramsin for that generous introduction. As he said, I'm Andrew Miles from Morningstar, and I'm just going to run through a couple of quick observations from Morningstar, and then we're going to get into the meat of the subject, and we're going to speak to the panelists here who you are already familiar with. So maybe just to start off with a quick disclaimer, and then going straight into this pie chart. So what we've done here is we've asked the advisor community, or at least our advisor community, which asset class represents the best opportunity for their clients. So we did this in June, so given how quickly the world's moving at the moment, it's a bit dated, but as you can see there, that sort of yellowy sandy colour is global equities. So that represents about 50%. So 50% of those advisors think that global equities is the best opportunity for their clients. The sort of bluey colour is Aussie equities, and then there's a sort of smattering of other asset classes in there, so alternatives and a few others. So that's quite a good backdrop really for what we're going to be talking about today, because the three gentlemen next to me are global investors, so that's a good start. The next slide, we're going to look at asset flows. So Morningstar collects a lot of information about funds, and one of the metrics that we follow quite closely is asset flows. So you can see broken down by asset class here to June 30th, the net flows. So this is, obviously inflows minus outflows over a 12-month period in blue. The sort of maroon color would be 24 months, and then the yellow is 36 months. So it's not as positive a picture for equities. There's been sort of modest outflows, but I would just put in a slight caveat that this doesn't capture institutional mandate wins and losses. So this is just for the sort of the wholesale non-institutional market. So just bear that in mind. The next chart is one that a couple of the speakers have referenced. And what all this is showing is just the difference between value and growth. And we've just used two MSCI indices and their definitions of value and growth. And what you can see, and this is going back since sort of the late 70s, is that it does seem to adopt a sort of cycle between value and growth. But what's really interesting, and Tim touched on it, is just how long value has underperformed growth, and just how sort of protracted, and in the last couple of months, just how sort of severe that underperformance has been. So no doubt we'll get into that in the panel discussion. And then the final slide that I just wanted to touch on, and this is a bit of a busy slide, so just bear with me 1 second. So all we're doing here is we're taking the constituents of the MSCI World Index, and we're plotting them, and on the x-axis, it's their PE ratio 3 years ago, and on the y-axis, it's their PE ratio at the end of July of this year. And so all this is really doing is showing, is the market sort of in aggregate getting more or less expensive? And the two key numbers to focus on is that 47% and the 53%. So that 47% is suggesting that 47% of the MSCI World is more expensive on a PE ratio basis than it was 3 years ago, and 53% less expensive. So I think that's quite interesting. Personally, I would have expected that number of more expensive to be a lot higher, but that gives you some context. So that concludes just my opening comments, and I think now it would be best to just go into the panel discussion. And so you know the guests already, so I won't introduce them again, but maybe just to start with a question about time horizons and how you guys think about time horizons. So Tim, maybe we'll start with you. Hyperion, sort of renowned for long-term structural growth companies and sort of backing hopeful winners early. How does this COVID environment alter, if at all, how you think about the long term and the short term?
Yeah, so that's a good question. Look, we've always been long term. That's 24 years of that. And if I had to highlight just what this pandemic has done, is it's highlighted some of those long-term tailwinds that have actually been exacerbated by the pandemic. So, the one that jumps out at everybody, I guess, is that people just aren't carrying cash anymore. They're tapping their cards or they're swiping their phones, and that's really driven the take-up of cards and digital payments, and it's really benefited businesses like PayPal and Square and MasterCard and Visa. People are all working from home. Like, that was all happening, but now it's really been exacerbated, and companies all around the world have had to quickly get ready for a world where people don't work in an office the same way they did. So, there's been some long-term trends that we've been counting on taking 10 years to roll out that have actually rolled out very, very quickly.
Okay, great. And Jacob, you've got a few more sort of weapons in your arsenal to manage the long term and the short term. How have you been sort of positioning portfolios, given that you've got the ability to go long and short and a few more levers in there?
Yeah, look, there's obviously, when real rates in the US are -1%, you've got this combination of, as Tim, the accelerant of COVID for a lot of the businesses that were already winning. They just kept, they've won even more. And most of those are not going to give it back. But there's probably a bunch of stocks in there that are genuine growth traps, that are trading like bonds and with not a lot of thought going into the business model. Very narrow SaaS company. Or an e-commerce company that maybe benefited from a shot in the arm from COVID, but its market share is going to be lost to Amazon. So I think in this environment, yes, the focus is always long term, but we think given PE dispersion is so extreme, not a little extreme, it's extreme, that there's going to be just as many growth traps as there are value traps. And as always, navigating that, regardless of what your toolkit is, it's the skill of the team and how those tools are deployed.
Great. And Andrew, just, you've got a more sort of focused investment universe than your colleagues next to you. How have you been thinking about short-term challenges, long-term trends, as the other guests have mentioned?
Yeah, I guess, what's the definition of long-term and short-term? I mean, we're all quarterly measured, and why not 5 minutes, and why not, the last 60 seconds? So we all say we're long-term investors. So this is I don't think any of us here are traders, but there's a difference between investment and speculating. And so we try to stay focused on investing. And if you look at the portfolio, it is about functional real estate. It is about relevant real estate. We're not going to pick the turning points and the subtleties in the short term. All we know is that good real estate platforms, the management teams are exceptional, the balance sheets will take advantage of opportunities, so we just stay the course. Try and understand what's a change in direction and an acceleration in trend. That's the great challenge at the moment. To us, it's really just an acceleration of what we've already seen. So for us, it's staying with our investments and not trying to speculate on the move to work from anywhere and all of the other sort of things that have come about, or the talk that's come about because of COVID. That to us is the great challenge, to cut out the noise, differentiate between what's noise and what's a Mack truck about to run you over.
Okay, great. One of the points that were made in the presentations, and Tim, you made some points about economic growth and things being quite challenged going forward from a growth perspective, and that has meant that you've avoided deliberately sort of more cyclical names, more value names, and we saw the chart there of just the underperformance of those sort of value companies. But I guess how much further can that go, and why is it that Hyperion believes that sort of backing that structural winner is the right sort of approach to take?
Well, everybody's looking for the mean reversion, yeah? But there are plenty of charts that will show you that there's been 40 years of outperformance by value, and there might be actually 40 years of underperformance by value. And I'm talking about deep value here. I'm not talking about what other managers perhaps here are doing, because I can see Jacob clearly is working on pragmatic value, which is a completely different idea. But sitting there and trying to buy busted flush companies cheaply is not a strategy in a low GDP market, because there just unable to turn around if there's no GDP growth, there's no economic growth. They're getting out-competed. There's a new world out there, and it's been coming slowly, but here it is 20 years later. These modern businesses with access to the internet are just completely out-competing old world businesses, and it's very hard once they get that first mover advantage to overtake them.
And just to stay with you, Jacob Mitchell sort of mentioned growth traps. Yeah, how do you sort of guard against maybe something becoming a growth trap?
Look, it's our greatest fear, yeah? And that's why I said at the end of my presentation, like these rules just don't apply to all companies. As Jacob has just said, there are huge numbers of SaaS businesses, particularly focused businesses, that could be easily out-competed in the future, and you can't lay your money in those bets. We're looking for businesses where we can see a line between their market share growth over the next 10 years and their earnings growth, not just this is a great idea that's going to work in the next year.
Okay, great. Jacob, yeah, for you, I mean, I suppose a similar thing that, value traps and growth traps, and I guess, how are you trying to balance having some cyclicality in your portfolio and then sort of backing, a bit like Hyperion, some of the sort of more structural winners?
Look, it's, obviously the more secular growth part of the portfolio has done much better. And stating the obvious, in the cyclical bucket though, I think it is looking for those companies. These labels are always dangerous. So, yes, there's commodities, autos, retail, financials, they're economically sensitive sectors. But not all the businesses are going to be necessarily cyclical, and there's best of breed companies in each of those buckets that can do well. Now, energy I think is probably the closest thing in our framework for a potential long-term value trap, in the sense that you are going to get on the margin, as we presented in the presentation, we're electrifying fossil fuels. And the only reason you do that is if you replace the fossil fuel with renewables. You don't go and, you don't turn your auto fleet into EVs and power them with coal. That sort of defeats the whole exercise. So coal, oil, at best they're supply stories. You are seeing significant rationing of supply. And so if you get a really low cost, high quality producer, maybe you can make an investment case. Or you can go and look at maybe a VW or a company like that, which we think is misunderstood, in terms of its transition to becoming an EV platform. So within most of these cyclical parts of the market, you can find, let's call them platform opportunities. Semiconductors, TSMC's got an amazing lock. It's where everybody ends up in the semiconductor industry. So looking for the resilient businesses in each of those buckets. And there's, we would argue, probably more chance of finding, I think, pragmatic value there today. Yeah.
Great. And Andrew, for you, I suppose, there's certain sectors of your investable universe where there's a lot of money flowing and there could be a growth trap. But yeah, how do you think about some of those where it's just very obvious that, the retail sector, even the office sector is just, everyone's talking about how sort of challenged they're going to be. So I know that you don't have a lot of your portfolio allocated to office, but there is a couple of names. So yeah, how do you sort of pick through a sector that is just, incredibly challenged?
Well, office is fascinating to us because office has always been challenged. The work from home is the latest threat to office. The reality is that office, if you look back over the years, it's been a very volatile area. And again, it's been a very poor cash flow area. Tenant incentives have always been a feature in the office market because it's a very commodity investment class where you see constant levels of supply coming through that really do act as basically a constraint on potential performance. What work from home and work from anywhere has done is just the latest chapter in a whole series of challenges for what is a very challenged area. So to us, yes, it's not an area that we see great performance in the long term. You will see it when it's trading at massive discounts to replacement cost. It gets interesting at that level. But even in New York, it's been trading at a huge discount to, you've seen high vacancy in New York for the last 5-10 years, and you're still seeing supply because of obsolescence, because tenants want the latest features, et cetera, et cetera. So for that area, we just don't get excited about, the big shiny buildings. What we're more interested in is the effective cash flows, and we can find better cash flows with less risk in some of the other areas of the market. Now, again, what we've found over the years is some of the ugliest property is in fact the best property. We had an investment in Link REIT in Hong Kong from basically since day one when it was listed. It owned terrible property. I mean, in terms of visually, wet markets and rundown shopping centres. But it was basic needs and the rents were very low. So you weren't paying a lot of money for a very strong cash flow. In fact, they sold their wet markets, thankfully, about 3 or 4 years ago at a yield which was about 2.5%. Now, when we bought into the portfolio 15 years ago, the whole portfolio was valued at about a 7.5% yield. So they sold their ugliest property at a 2.5% yield. Now, to us, again, it's about the cash flow and better appreciation of true cash flow that really counts.
And just sticking with you there on some of the sort of the more sort of sexy sectors of data centers and those sort of industrial. How do you guard against? Because again, it's a trend that's very well known. The stock price of NXTC and others.
Yeah.
How do you guard against that?
So again, there's data centers and there's data centers. There's wholesale data centers which just literally store data, and they're pretty low value to us. Then there's what's called these network dense data centers, which are literally like serve the purpose of an old telephone exchange. It's where all the different internet connections occur, typically on cable fiber networks, high power redundancy that's required. So you just can't replicate that. And with the growth in traffic and Internet of Everything, this is an ongoing key infrastructure area that's very hard to replicate, that therefore the landlord has pricing power, and that we believe to be a long-term secular winner. We think the returns are very secure. So people keep underestimating it, and to us that's fine. That's what we want. But when they pay too much for commodity data centers, we wish people well in chasing that thematic.
Okay, great. Maybe moving on and shifting gears a little bit, and from our meetings with you guys over the years, a lot of what you do is a lot of meeting with companies, understanding management teams, and I suppose at the moment it's difficult to do that, but with a lot of the stimulus, monetary policy, fiscal policy, how, do you start to sense that might change how management teams allocate capital and take risks just because money is almost free, and you can
so the government should just keep doing it every year. Just tip some more money and make us all feel better. Why not? Seems to work, doesn't it?
Yeah, but is there?
We're turning Japanese. That's what's going to happen. If GDP growth goes the way that we think it will for the next 20 years, because population growth isn't there, there's all of these headwinds. Governments will just continually tip money in. That's what it's going to look like.
And in that environment, you think the structural
massive agency issues. Obviously, money will go to the wrong way. Rorting will occur. There'll be opportunities, but there'll also be, you'll invest in something if you're not careful, and the government will switch horses politically, and all of a sudden that won't be funded anymore. So it's not a free lunch.
Yep.
In a pandemic, everyone's a socialist.
Well,
we've seen
maybe the Chinese are probably the least socialist today, ironically, of any government, right? So they're not going down that path. And interest rates, real interest rates in China, well, let's say nominal interest rates in China are 10-year is trading at over 3%. So, it's not quite right. I think, if you think about, and when you look at Japan did most of its QE, let's call it fiscal stimulus, without an enormous amount of QE. It was funded internally, and they've always run current account surpluses. So I think the world's maybe bifurcating into stronger currency zones and weaker zones. And the US went into COVID with a 4% fiscal deficit in an economy that was booming, right? So and they've always been a trade deficit country, and they still are, even with the tariffs that they've put in place. So the US is going on I think, quite a different trajectory to the rest of the world. Europe's big trade surplus, always has, internally funded system. So I think you got to prepare maybe for a change in the US versus the rest of the world. Much weaker dollar and potentially ultimately, even if I don't think we're permanently in a low growth environment, which Tim and I, we've debated, I'm sure, ad nauseum, but the US may be just yes, the rate of growth is declining, but the composition of growth can be very different in any decade. So maybe a little bit more inflation or at least volatility in those outcomes. So maybe there is a price to pay for open-ended fiscal stimulus.
And Andrew, any other comments from you just on that sort of all the stimulus and maybe the moral hazard that it might create with the managers of the assets that you invest in?
Look, I mean, to us, again, what's been fascinating is to see the tension between the tenant and the landlord in certain areas at the moment and how they're playing that. And there's been certain groups that have been, I think, playing it very cleverly in terms of, I've never heard a tenant complain that their rents are too low. And so they're using the pandemic to basically try and improve their lot. I mean, the latest is Qantas, trying to threaten they're going to leave their Sydney headquarters, which is leased to a REIT with 12 years left on the lease. Well, good luck. I mean, Alan is obviously doing his best to try and negotiate a better position because he's seen his major competitor out there getting a cost advantage. So he's doing what he should try to do. But the reality is, what we're seeing is, you can't, unless we're going to have literally anarchy in contracts, then a lease is a lease is a lease. So what we like is the quality of the cash flow that comes from long-term leases. We think that story remains intact.
Great. Again, maybe just switching gear, and it's something that just we get a lot of questions about. I'm sure that the three of you get a lot of questions about, and it is sustainability and ESG. And it's interesting just the comments you made. Yeah, I suppose it means a lot of different things to a lot of different people. But yeah, maybe at Hyperion, I guess your time frame allows you to be an ESG investor. But yeah, what are the sort of the key things that you and the team focus on?
Well, isn't it interesting that just in recent years, there's an awful lot of asset owners that are starting to focus on products that kill the consumer, the customer, tobacco, that kill the environment, coal, and that kill other people, munitions. And I mean, that's just like, we've considered those uninvestable, since inception. Mm-hmm. So like the winds are changing. I mean, people with real large amounts of money are actually saying you can't do this anymore. Where does it go from here? Well, we think it should go to sustainability of earnings. That's what it's like. I mean, tobacco, we think in the very long term, you just kill off all your customers. So that's not a sustainable business. And coal won't be, steaming coal won't be either. So we think while there might be short-term opportunities for some traders to get into those and trade the opportunity, we think that the winds have changed, and COVID's actually focused people's minds on what clear air feels like, and that'll just push this even further.
And Jacob, with you, I suppose you can potentially capitalise from sort of the bad actors from an ESG perspective. How do you sort of incorporate it at Antipodes?
It's embedded in the bottom-up research process, in the sense that all of us, I think, would have a minimum level of environmental behaviour, governance, social in all their investee companies, and the ones that maybe are only just above that minimum, you're looking for evidence of improvement, because that's good for all stakeholders, including shareholders. In terms of the second aspect, which is really trying to interpret what Tim's referring to, the outcomes, because there's real world outcomes and then there's also investor preference outcomes. And we think, decarbonisation is just a real world outcome. I think regardless of your political views over time, I think we're going down a path of decarbonisation. And obviously great investment opportunities are thrown up by that. And, in areas of the market that aren't necessarily super, let's call it crowded today. They're part of that dispersion opportunity.
And Andrew, I mean, you've got a lot of reporting on sort of the carbon intensity of the assets you own and things like that. Apart from that sort of reporting side of it, how does it sort of play into your and the team's thinking when sort of stacking up an investment?
Well, I can honestly say the listed market has been, to us, very constructive and proactive in the whole issue. I mean, there's always the risk of greenwashing, and that's something we certainly are very cautious about. We do believe in walking the talk. And so what's been disappointing is that I think the landlords have actually been proactive. Some of the tenants haven't been as on board. So you need to see tenants and landlords working together. But then we see really interesting examples where it's going to putting the onus back onto investors to actually think about how it plays out and what they're prepared to pay. We've got a vehicle that's currently not in the portfolio, but we really like the stock. It's called Alstria. They've got the option they've put the option back to shareholders. We can pay a dividend of €20 a share, or we can retain money to reinvest in the portfolio that's not going to be immediately earnings accretive, but it improves the carbon footprint of the portfolio. Now, we can pay €19 a share, retain €1 to spend. We're giving you the option to elect. So I think that's the sort of engagement that we think is fantastic, because it brings to the fore the whole issue. What are people really prepared to pay? Do they really understand the issues? And that to us is outstanding management to challenge investors.
Great. Maybe just, I'm just sort of conscious of time. Maybe one more question. And sort of the way that the three of you run money is active, concentrated. And this is a selfish question for me, because we get a lot of questions about concentrated portfolios versus diversified. So I'd just be interested to get your take on why having a concentrated portfolio is the way forward. And why, because you founded these firms, why that was the way to go first. And maybe we'll flip the order around. Andrew, maybe we'll start with you. You're sort of a concentrated investor.
Well, let me start with my pet hate, which is the index funds. They are leeches on the investment market. So let me be clear about that. In terms of concentrated, I've invested my money in the funds. I don't want to just spread the money around. I actually want to invest in what I believe to be stocks and real estate that is going to produce long-term wealth. Why have 100 when really there's, frankly, we've got 45 stocks that we think are capable of really producing the goods. Now, to own more, we think with spreading yourself too thin, you really basically want to support those stocks that you think are going to be the key outperformers.
Jacob, maybe turn to you.
Yeah, look, I mean, Antipodes' take on that is, I think there's a great focus gained from, we wouldn't sort of obsess too much by the stock count, as opposed to, well, how many ideas are reflected in the portfolio across, we have on average roughly 60 stocks in the long book. We would say that's 8 to 9 different clusters, and we think that really adds productivity to the research process. You do a large piece of work on something like the semiconductor industry, out of that you're likely to find 3 or 4 opportunities across a sector that has 50 stocks in it. So we think that's an appropriate way to invest. So we get the benefits of some single name diversification, but in a fairly focused portfolio. Productivity stays high. Your analysts aren't spread too thinly. And it also, I think, is a way to think differently about risk management. You're looking for, let's call it, low correlation between each of those sort of 8 to 9 ideas.
Then Tim, final word from you.
Well, what you've seen, in our 24-year track record, we've always been concentrated, and it's delivered the returns. That research I showed in my presentation, that number jumps out at you. 96% of businesses over 100 years actually did not deliver a return better than T-bonds. Seriously, if there was ever an argument for concentration, that's it.
Okay. All right, gents, thank you very much. We'll have to end it there, but please stick around for the rest of the program today, because it's fantastic. Thank you, gents.